All right, let's dive in. Today, we're going to take one of the most respected investment philosophies ever created and turn it into a practical, modern day strategy you can actually use. We are going to build a financial fortress, brick by brick, using the timeless wisdom of the one and only Benjamin Graham. So, let's get to it. I mean, seriously, does investing sometimes feel like you're just at a casino? If you've looked at the market recently, you'd be forgiven for thinking that. You've got meme stocks soaring to the moon, cryptocurrencies popping up out of thin air. It can feel like you need a crystal ball, not an actual plan. It's overwhelming, and it's so easy to feel like you're just rolling the dice with your hard-earned money. But what if I told you there's a blueprint for building a financial fortress? A strategy that's designed not for those thrilling gambles, but for withstanding the inevitable chaos of the market. This is the absolute core of Benjamin Graham's philosophy, and honestly, it's more relevant today than it has ever been. Okay, so before we can start laying any bricks, we first have to get our heads in the right place. We need to understand the philosophy behind the fortress. This isn't about attacking the market and going for spectacular gains. No, this is all about defense. It's about protecting what you have, first and foremost. Just listen to the humility in that quote. Graham isn't telling us to go find the next big revolutionary company or to get these brilliant world-beating returns. The goal is so much simpler, and because of that, so much safer. Just protect your capital. Your main job is to avoid the big portfolio-killing mistakes. And this lays it all out, doesn't it? You've got two completely different paths. The speculator, they're chasing excitement, the quick profits, always hunting for those rare gems. The defensive investor, on the other hand, is playing a totally different game. Their method is to systematically avoid errors, putting safety way, way ahead of thrills. So you have to ask yourself, are you building your portfolio for safety, or are you building it for excitement? Okay, so every good fortress builder starts by surveying the landscape, right? You need to know where the quicksand is, where the pitfalls are. So let's begin by identifying the building materials that Graham tells us not to use. Graham was crystal clear about what a defensive investor needs to steer clear of. You know, those financially weak or small companies that could get toppled in a strong wind. Companies that are just loaded with debt. And maybe the most important one, those fashionable stocks, the ones driven by a great story instead of solid numbers. These are not the materials you use to build something that's meant to last. And just look at how perfectly this translates to today. It's almost crazy. Fashionable stocks? That's today's meme stocks. Speculative growth? Well, that's those disruptor companies with amazing stories, but absolutely no profits to back them up. His warnings from decades ago could have literally been written this morning. The hazards haven't changed one bit. They just have new names. All right, we've mapped out all the dangers. Now it's time to build. We're going to construct the 4 essential walls of our financial fortress, and we're going to do it using Graham's strict, time-tested criteria. So the first pillar is size. But for Graham, this was never about prestige or just being a household name. Nope. Size was really a stand-in for survivability. Large, established companies are simply more resilient. They have better access to capital when a crisis hits, and they're often more diversified. Bottom line, they're just harder to knock down. And it's really that simple. Just think of a giant oak tree versus a little sapling in a storm. Size is a fundamental element of strength, and it dramatically reduces the odds of things breaking. Pillar number 2, financial strength. Look, a company's story doesn't matter one bit when a crisis hits, but its balance sheet sure does. Conservative debt levels and strong cash reserves mean the company isn't living on the edge. You see, while a ton of debt can magnify gains, it also magnifies errors, and that's a risk a defensive investor just refuses to take. And this is exactly why it's so critical. A strong balance sheet gives a company breathing room. It literally buys them the time they need to weather economic storms that would absolutely bankrupt weaker companies. Next up, earnings stability. We are not looking for a company that had one incredible blowout year. We're looking for a company that has proven it can make money consistently, through good times and bad. A long, steady track record of profitability is so much more valuable than short-term, exciting growth, mostly because it's just more predictable. And this is just a fantastic way to think about it. Every single year of consistent profit adds another layer to your margin of safety. It creates this buffer against uncertainty and, let's be honest, against the inevitable mistakes in our own forecasts. Our 4th and final wall is a solid record of consistent dividend payments. Now listen, this is not about chasing the highest yield. For Graham, dividends were a really powerful signal. They show that a company is genuinely profitable, not just on paper. and that its management is disciplined and focused on returning cash to its owners, the shareholders. I absolutely love this quote. A company's big future plans, that's just optimism. A dividend check in your account, that is cold, hard cash. It's the ultimate proof that the business is actually working. Okay, our fortress is built, the walls are high, they're strong, they're based on size, financial strength, stability, and dividends. But even the mightiest fortress in the world can fall if you just leave the front gate wide open. And that gate, that's the price you pay. This might be one of the most important questions in all of investing. You can find a wonderful business that meets all four of our criteria. But does that automatically make it a good investment? And the answer is a huge, resounding no. Quality does not justify paying any price. Overpaying for even the best company in the world is one of the fastest ways to lose money and completely undermine your entire defensive strategy. This right here is the capstone to the whole structure. Your discipline on the price you're willing to pay is what ultimately protects you. After all the research, after you've confirmed the quality of the business, the price you pay is the final lock on the gate of your fortress. So let's just take a step back and look at what we've built here. We can now take all of these pillars and synthesize them into a single, powerful, and actionable checklist. And here it is, the whole thing boiled down to 5 simple, non-negotiable questions. Is it a large established business? Check. Does it have a strong financial condition? Check. Does it have a long, stable record of actually making money? Check. A history of consistent dividends? Check. And finally, the big one. Is the price reasonable? Check. This checklist, this is how you replace hope and speculation with clear, objective standards. And that really leaves us with a final thought to chew on. We live in a market that seems to celebrate complexity, daring predictions, and these flashes of brilliance. But what if the true, enduring genius of investing isn't about being brilliant at all? What if it's simply about being disciplined, being patient, and above all else, just being sensible? Something to think about. Thanks so much for joining me.